In this video, I am going to show you the exact stock investment techniques that millionaires use, and I'm going to show you how to apply every single one of them with a low investment, starting today. But before I get into the techniques, I want to share one fact that is going to make you feel uncomfortable. A $5,000 investment in Nvidia made 10 years ago is now worth over $1 million. You did not need to be rich to make that investment. You did not need a financial advisor. You did not need inside information. You needed one thing, the knowledge to recognize what you were looking at. That is what this video is going to give you. I put a lot of research into this video, real data from millionaire investors, verified 2026 strategies used by people managing billions of dollars, and the exact principles that separate the people who build wealth in the stock market from the people who lose it. By the end of this video, you will know 7 specific millionaire techniques, each one applicable with low investment, and you will understand exactly which one to start with based on where you are right now. Stay with me for the full video, because technique number 6 is the one that most investors, including experienced ones, completely overlook, and it might be the most powerful one on this entire list. Let us go. First, let me destroy the biggest myth about stock market investing. Most people believe that the stock market is for rich people, that you need $10,000, $20,000, $50,000 to get started, that the techniques the wealthy use are out of reach for regular people. Every single one of those beliefs is wrong. The research is clear. The strategies that millionaires use, long-term thinking, diversification, value recognition, compounding, apply to everyday investors, regardless of how much they start with. You do not need millions to benefit from the investing strategies the ultra-wealthy use. You need the right knowledge applied consistently. So let me give you that knowledge now. Millionaire Technique 1, Dollar Cost Averaging, the technique that removes all the fear from investing. Here is the concept. Instead of trying to time the market, instead of waiting for the perfect moment to invest, you invest a fixed amount on a fixed schedule, every month, without fail, regardless of whether the market is up or down. This technique is so simple it sounds almost too boring to be powerful, but here is what the data shows. The S&P 500 has a historical average annualized total return of about 10.5% over the last century, and the research confirms the longer your time horizon, the more likely the index is to match that expected return. You do not need millions to benefit from the investing strategies the ultra-wealthy use. You need the right knowledge applied consistently. So let me give you that knowledge now.
Now, here is the specific number that should make you stop and think. Consistently investing in a boring ETF will build a $1 million portfolio without ever needing to buy the latest can't-miss growth stock. If you invest $200 a month into a low-cost S&P 500 ETF at an average return of 10%, you will have over $400,000 in 30 years. $500 a month becomes over $1 million. You did not need to pick a single winning stock. You did not need to time a single market move. You just needed to show up every month with a fixed amount and let compounding do the rest. The entry point for this technique, as little as $1. Fractional shares make it accessible to anyone. Make it automatic. Set it and forget it, and never touch it. Millionaire Technique 2, Index Fund Investing, the favorite technique of actual millionaires. This is not theory. This is what real millionaires actually do when surveyed. Time and time again, millionaires mention index funds as their favorite investments. One millionaire investor described it this way. It took him 8 years to save his first $100,000 in his retirement account. Now he earns that same amount in 3 months, purely from compounding inside index funds. Exchange-traded funds and index funds are widely used by millionaires who value low-cost and diversified investments. In 2026, these instruments remain popular because they track market indexes and reduce the risks associated with picking individual stocks. The specific funds that come up repeatedly, VOO, which tracks the S&P 500, VTI, which tracks the entire US market, and QQQ, which tracks the NASDAQ 100, all of them available with no minimum investment through most modern brokers. The reason millionaires love index funds is not because they cannot pick individual stocks. It is because they understand that over the long run, the index beats most individual stock pickers almost every time. Many millionaires list buying individual stocks as their worst investments. The ones who gave it up in favor of index funds consistently outperformed. Low cost, simple, powerful, and completely accessible with any starting amount. Millionaire Technique 3. Value Investing. Buying $1 for 80 cents. Value investing focuses on identifying stocks that the market undervalues, companies trading for less than their intrinsic value, the fundamental worth based on underlying business, assets, and earnings potential. The concept, popularized by Warren Buffett, is this: the stock market regularly misprices companies in the short term due to fear, news cycles, and emotion. A great company that has a bad quarter, or exists in a sector that is temporarily out of favor, or simply has not been discovered yet by mainstream investors, that company's stock may trade below its real worth. Value investors find those companies, buy them at a discount, and wait for the market to recognize what they already know. The research confirms that millionaires reinvest dividends, avoid emotional decision-making, and hold investments through market cycles to maximize long-term returns. You do not need to buy expensive stocks to value invest. You need patience, research, and the ability to think independently from the market's emotional swings. Millionaire Technique 4. Dividend Investing. Getting paid to own stocks. Here is a concept that most beginners never learn about. Dividend stocks pay you a percentage of their profits, called a dividend, simply for owning their shares. You do not need to sell anything. You do not need to time the market. You just need to hold the stock and collect the payment. In 2026, strong dividend-paying sectors, healthcare, consumer staples, infrastructure, utilities, are among the most recommended by institutional investors for stable income. BlackRock's 2026 outlook specifically highlights dividend stocks as a key component of income generation in the current environment of easing interest rates. The compounding version of this strategy, reinvesting every dividend payment back into buying more shares, is one of the most powerful wealth-building mechanisms that exists. You buy shares, the shares pay dividends, you use dividends to buy more shares pay more dividends. The cycle compounds indefinitely. This is exactly what Warren Buffett means when he says his favorite holding period is forever, because forever is when compounding becomes extraordinary. Entry point: dividend stocks can be purchased as fractional shares for under $10 on most modern platforms.
Millionaire Technique 5. The Barbell Strategy. Protection and growth at the same time. This is the technique that institutional investors, the people managing billions, use to navigate uncertain markets. The barbell equity approach involves blending growth-oriented assets, very risky, with purely defensive plays, very safe, to balance volatility and avoid the middle ground. In practical terms, one side of your portfolio holds high-growth assets, technology, artificial intelligence, emerging markets, high risk but extraordinary upside. The other side holds defensive assets, dividend stocks, bonds, infrastructure, low risk but stable returns. By holding both extremes simultaneously, you capture the upside of growth in good times while being protected by defensive assets in bad times. The middle, average stocks with moderate growth and moderate risk, is where most investors put most of their money, and it is the least efficient place to be. Nuveen Investments confirms that AI and tech dominance will likely persist, but it makes sense to balance that with allocations offering resilience to downturns, inflation protection, and stable growth. You can implement a barbell strategy with any amount: 50% into a broad market ETF, 50% into dividend-focused defensive funds. Rebalance once a year. Millionaire Technique 6, the one most investors miss: consistent reinvestment during market drops. Here is the uncomfortable truth that separates millionaire investors from everyone else. When the market drops, most people panic and sell. Millionaires buy more. Wealthy investors commit to their investments for the long haul instead of chasing quick profits or reacting to market noise. They only invest when they truly understand the underlying business, rather than getting caught up in daily price swings. This means a market correction, a drop of 10 to 20%, is not a crisis to a millionaire investor. It is a sale, a discount, an opportunity to buy the same quality assets at a lower price. The research consistently shows that the single biggest driver of underperformance in retail investors is selling during downturns. Every time an investor panics and sells at a loss, they lock in that loss and miss the recovery, and markets always recover. The technique: never stop your regular investment contribution regardless of what the market is doing. When the market drops by 20%, consider doubling your contribution that month. Buy the discount. This one behavioral shift, treating drops as opportunities rather than disasters, is worth more than any stock tip, any analyst recommendation, or any hot sector trend. Millionaire Technique 7. International Diversification, the opportunity hiding in plain sight. International diversification should be the priority of investors in 2026, especially those overweighted in the U.S. market. The rising middle class in India is driving domestic consumption, corporate reforms are putting Japan's companies on the global map, and Southeast Asian countries are benefiting from global supply chain diversification. Most retail investors put almost all of their money into U.S. stocks, but the U.S. market represents less than 60% of global market capitalization,
The other 40%, international markets, emerging economies, frontier markets, is largely untouched by regular investors. In 2026, markets in India, Japan, and Southeast Asia are specifically highlighted by institutional research as having valuations significantly below US market multiples, meaning the same quality of company costs less to buy outside the US. A simple international ETF like VEU, Vanguard All World ex-US, gives you exposure to thousands of companies across the entire world with a single low-cost investment.
Here is the framework that ties all 7 techniques together. You do not need to use all of them. You need to pick the 1 or 2 that match where you are right now and apply them consistently. If you are starting with almost nothing, dollar cost averaging into an index fund, $1 every month automatically. No decisions, no timing, just consistency. If you have some capital and want income, dividend investing. Buy quality companies that pay you to own them. Reinvest every payment. If you are experienced and want to optimize, the barbell strategy and value investing. Protection on one side, growth on the other. Patience throughout. And regardless of which technique you use, technique 6, buying more when the market drops, applies to every single one of them. That one behavioral advantage compounds silently over time into results that will shock you when you look back.